This year's risk-off selling spree in the cryptocurrency market, which was sparked by a Federal Reserve that was suddenly determined to rein in excesses, has revealed a web of interconnection that resembles the maze of derivatives that brought down the global financial system in 2008. So in this video we will discuss about a $2 trillion free fall rattles crypto to the core. A variety of alternative cryptocurrencies also fell as Bitcoin dropped nearly 70% from its all-time high. The much-hyped experiment in decentralized banking Terra ecosystem collapsed as a result of its algorithmic stablecoin losing its peg to the US dollar and a bank run that rendered $40 billion of tokens basically worthless. Cryptocurrency collateral that appeared to be valuable enough to support loans one day became sharply devalued or illiquid, casting doubt on the futures of several well-known lenders and a supposedly unbeatable hedge fund. The causes of the catastrophe, like as greed, excessive leverage, and a rigid belief in number go up, are nothing new. They were there when almost every other asset bubble burst. In crypto, however, and particularly at this particular time, they are suddenly entering a brand new and mostly unregulated market where borders are blurred and failsafes are undermined by the belief that everyone participating could become wealthy. Before we continue, subscribe to our channel for more crypto-related videos and updates. Although cryptocurrency has had multiple significant decreases in price over the years, known by insiders as crypto winters and by the rest of the financial world as bear markets, more is at stake now due to the market's expansion and growing acceptance from Main Street to Wall Street. It's one thing for Kim Kardashian to promote a cryptocurrency that promptly plummeted, but Fidelity's ambitions to include Bitcoin in 401(k)s might have an impact on an entire generation. Its expansion has further increased the resonance of the turbulence this year. When the previous two-year crypto slumber ended in 2020, the sector's total assets soared to around $3 trillion before falling to less than $1 trillion last November. Jason Urban, co-head of trading at Galaxy Digital Holdings Ltd., stated in an interview that it has a new flavor this time. Galaxy, the $2 billion digital asset brokerage established by billionaire Mike Novogratz, profited greatly from the ascent of cryptocurrencies while simultaneously participating in the Terra experiment as one of the most notable investors in the sector. Being a victim of your own success, in all honesty, is it? Continue reading. Novogratz speaks out. Labels Luna a big idea that failed. Many believe that the Lehman Brothers moment is imminent if Terra were bear stearns of this crypto winter. Similar to how the inability of lenders to meet margin calls served as an early warning sign of the 2008 financial crisis, cryptocurrencies have experienced their equivalent this month. Celsius Network, Babel Finance, and Three Arrows Capital all disclosed significant issues as the prices of digital assets fell, causing a liquidity crunch that ultimately results from the interdependence of the sector. In 2022, the downturn will resemble a classic financial deleveraging much more, according to Lex Sokolin, global co-head of fintech at Consensus. All of the terminology used, such as run on the bank and insolvent, is the same as what would be used to describe a healthy but overheated traditional banking sector. In both instances, consumer confidence and the perception of dishonest actors undoubtedly played a part. But right now, money is leaving deployed operational systems as a result of excessive leverage and inadequate risk-taking. Leverage allows investors to increase their profits while spending less money during bull markets, but when the market declines, such positions quickly unwind. Furthermore, because they include more than one type of asset due to the nature of cryptocurrency, such bets increase the likelihood of market contagion. As most of the rest of the cryptocurrency market fell on Monday, Bitcoin also declined, falling roughly 3.5% to $20,650 as of 10:30 a.m. In New York, the largest token in the world has decreased by around 35% just 1 month. The crypto market is only slightly above the $830 billion figure it hit in the beginning of 2018 before the previous winter set in, sparking a downdraft that drove the market as low as nearly $100 billion at its lowest point, according to CoinMarketCap data, and is now back around $1 trillion. Then, a small group of crypto-focused funds and devoted retail investors utilized digital assets as their playground. This time, The industry has expanded its appeal to include both small-time investors and hedge fund tycoons, prompting regulators to routinely step in and issue comments alerting consumers to the risk of trading such assets. In late 2020, a notorious, now banned, advertisement on London's public transportation system read, "If you're seeing Bitcoin on a bus, it's time to purchase." Unfortunately, this doesn't make the majority of crypto wagers any easier to comprehend. The latest crypto market crisis was made worse by its experimental and speculative nature, wiping out small-town traders who invested their whole life savings in unproven ventures like Terra with no recourse. This is true even though the majority of the financial world is suffering in 2022. And the hype machine for the industry is blasting louder than ever, bolstered by new generations of crypto acolytes on platforms like Twitter and Reddit. Additionally, exchanges have played a role, with FTX, Binance, and Crypto.com all investing in marketing and prominent sponsorships. The tremendous amount of risk, according to Sina Meyer, Managing Director of Cryptocurrency Fund Management 21 Shares AG, is the reason why cryptocurrency isn't suitable for everyone. She stated during a panel discussion earlier this month at Bloomberg's Future of Finance conference in Zurich, "Some people should certainly stay away, since they only follow the news they read in the newspapers. Many retail investors are lost." That is erroneous. The financial environment is very different this time. Many businesses that emerged from the previous freeze have turned to venture capital fundraising as a more established method of money raising, like non-fungible token and gaming platform Dapper Labs. According to data from PitchBook, giants like Andreessen Horowitz and Sequoia Capital invested about $43 billion in the industry since the start of the previous bull market in late 2020. This means that some of the industry's largest players don't just rely on their crypto assets. They also have sizable cash reserves set aside to help them get through the blizzard as they develop new blockchains or create decentralized media platforms. However, since the bull market has ended, they have been spending that money far more quickly than it has been pouring in. Several cryptocurrency companies have announced mass layoffs this month, blaming the overall macroeconomic downturn for derailing their formerly ever-expanding goals. These include Coinbase Global Inc. And even while VCs may now be more selective about where they invest their money, it still needs to be spent. This finishes our today's video. Do share your feedback with us in the comments and subscribe to our channel for more. Thanks for watching.